Hey guys, welcome to this session. In the previous session, we had discussed a lot about market structure and we found out how to place trades on the market based only or entirely on swing points, that is identifying your higher highs and higher lows and premium and discount ranges and where to enter in the charts. So in this session, we're going to sweeten the deal a bit by learning about supply and demand zones. So these are areas on the chart that serve as a complement to what we did last time, and let's get to it. So usually what happens in the market again is price movement is as a result of buyers and sellers on the chart. So when buyers and sellers interact on the chart, we have price or the price chart being the footprint or the result of that action. And it is possible to identify where there was significant buying and selling within the chart. That is going to eventually help us see where next to look for buying and selling opportunities. So it's really looking for those optimal entry areas as a trader that are going to give you even higher probability setups. Now remember, we've already touched a lot about how to identify a change of character as our entry point onto the charts or onto a trade, but having more confluence on that is even going to make that probability of success higher. So that's why we'll be covering supply and demand zones in this session. So let's start by defining them. You can simply state a demand zone as an area on the chart where a significant level of buying power arose that resulted into a sharp move of prices upwards. Yeah. So a demand zone is an area in a price chart with a significant level of buying power resulting in a price increase or a reversal of a downtrend. So maybe if you're in a downtrend, for example, and buyers quickly came into that market and then they might have caused prices to go up. So you can say that at that specific point, that's where buyers came into the market, and that's a potential for us to find buys in a later time when you're looking at your charts. So market participants will enter price at these positions quickly, or the ones who are selling, for example, in a demand zone, quickly exit their sell positions because it might be very difficult for prices to continue going lower. So those are key areas you're looking at in the market. Remember, prices go higher when there are more buyers than sellers in the market, and when there are more sellers than buyers in the market, prices tend to go low. So identifying those critical areas in the chart can give you optimal high probability setups when prices finally go back to those zones. Now, a supply zone, on the other hand, is an area on a price chart with significant selling power. So this is where you see a lot of sellers coming in. And again, we've said prices are as an interaction between buyers and sellers. So if you see a significant price drop on the chart, then that can tell you that at this point, probably a lot of sellers overpowered the buyers and prices sort of had a sharp turn or a sharp move downwards. Now, you can see that we've stopped talking about patterns. We've stopped somewhat talking about what the shapes and the candles are on the chart, and you're more inclined to talking about what buyers are doing and what sellers are doing. So as a trader in your journey, you sort of shift from just seeing the patterns as is to sort of thinking about what is happening in the background, what are buyers doing and what are sellers doing. Once you understand price movement from a perspective of buyers and sellers, that's basically supply and demand theory. Then you have an in understanding when you go back to the market structure video, for example, to try and see exactly what is going on in terms of price movement. So if you see a sharp or a big candle, for example, then you can tell that there were more buyers and sellers, significantly more buyers and sellers, and that is a region to watch out for. Okay, so that's basically it for a demand zone and the supply zone. And there are two types of, so let's just look a bit deeply into these zones. Okay, so when it comes to defining these zones, they are divided into two categories. And the first one, if you get into the supply or the demand zone, can start with the demand zone. The first one is we have a scenario where prices drop, and then they have this sort of consolidation, and then you have that rally. So this is where prices sort of accumulate. So you have buyers and sellers deciding on the direction, and then when large market orders come into the market, we have that push upwards. So this region here becomes your demand zone. So we have this entire area over here being that area on the charts where the demand happened. And the other type of demand zone that you can find or you can observe on a chart is a rally base rally type of demand zone. So in this case, we had prices going higher, and then we had a consolidation midway, and then afterwards prices continued higher. So in this case, this is still a demand zone because we had market participants resting and more orders being accumulated before finally us going higher. So we have two types. We have two types of demand zones, and that's a drop-based rally or a rally-based rally. And the same can be said when talking about a supply zone. So it's quite the opposite of a demand zone. So in this case, we have prices rallying into a certain region, and then obviously prices rally because there are more buyers than sellers, and then orders sort of start being matched. In this case, now we have consolidation, which is brought as a result of buyers matching sellers. So this entire move is dramatically stopped at this point because now there are orders coming into the market. Yeah. And the pace at which we see this move being stopped is also very significant, because you can think of it as a large rock rolling downhill. If it gathers a lot of momentum and it's instantly stopped, then you can tell that there are very many or very huge orders to stop this momentum. So we had that rally base and then drop. Yeah, so a rally base drop supply zone or a drop base drop supply zone. So those are basically your two types of supply zones that you have on the chart. So let's have a look at some of these on the charts before we continue. So remember, all you're looking at is trying to identify where can we see a lot of pressure in the markets in terms of what buyers are doing vis-a-vis what sellers are doing. So we have a very I wouldn't say neat example, but we have a very interesting example over here. You can see that we had this push. So we had this push downwards over here. Yeah, so you can see this was a very strong downtrend. So that was a sort of a drop. And then what came afterwards was we had some small candles over here. So we had this bearish candle and a few small candles, and then the candles finally became large and we went back higher. So this was a drop base rally type of zone down here. So what happened the next time we had prices coming back into that zone, which was over here, we had buyers or buying interest coming back. And why? Because this is a very significant point for us, because this entire move was stopped over here, and that's when we had a push higher. And another point to look at is here, where prices seemed to be dropping. So we had this entire push down there. Yeah, and you can see this is caused by this. So this push down here eventually led to buyers coming into the market and us going higher. So this was a rally and this was a consolidation over here, and the market was dropping. So this was an area of interest, and this is the same point that this price came back into and sort of rallied from there. So this was a drop, and then we had a small consolidation over here, and then a rally, of which that's what happened again. And this one can be pegged off of the back of this. So here we have another move. Let's see, just take my crosshair like that. Yeah, so we had another move over here. This one was a bit smaller. It wasn't as aggressive as these two, but we had a push from this point over here. And remember, this coincides with what we talked about. So this is a significant low in market structure because it broke the previous structure. The base of this broke the previous structure as we went along on the uptrend. So we had that uptrend over there, and then we had the second type of zone that we've been talking about, which is a rally, base, rally type of zone, a demand zone. So we had a rally like that, a base like that sideways, and then we had the market pushing higher like that. So this formed an area of interest on which buying participants came back into the market. So you can see there's a very thin line between understanding market structure and just from a pure price perspective and just looking at the market in terms of buyers and sellers. And you can find very interesting opportunities if you opt to blend both market structure and supply and demand. So let's quickly resume our notes and see what are the definitions. So we usually have a lot of mix-up when it comes to order blocks and supply and demand zones. But most of the times, or some of the times, traders will attempt to use order blocks to identify supply and demand zones. But simply put, from our definition, a supply zone or a demand zone are areas where we had a small accumulation and then prices shot up or down significantly. So it's defined by a base and then a move upwards or downwards. Using order blocks makes that definition a bit easier. So we can just define an order block, which in some cases isn't so far away from a supply or a demand zone. So an order block can be identified as a specific candlestick or bar that, when properly viewed in an institutional context, can highlight smart money buying and selling. So basically, this is where a lot of orders come in and result into that price either shooting up dramatically or going lower dramatically. In an institutional context, this means observing market behavior that reveals the pileup of orders in large entities. So basically, what you're looking at is the point where we had that push upwards. And you can see even on this push upwards, we went to another zone, which was a supply zone. So you can see that supply zone, using supply zone and demand zone is, as a definition, is much broader than using order blocks, because this entire point, this was an imbalance that we'll talk about. This was a market move that you can say the top here was a supply zone, and that's where this candle, this move went into. So it ran into this region over here before coming back down. But here we have no clear order block. But at the same time, let's try and define what order blocks are. And that is, a bullish order block is the last down candle at or near a support level before the move up or before a move up. So it's usually or typically the last candle you see before prices shoot up. So this is the last point we had sellers being strong before buyers coming into the market, simply put. Yeah, so, and that's how you identify a bullish candle. And then in the other case, a bearish candle is the last point where, or a bearish order block is the last point where buyers were strong before now sellers came into the market. So you can see the definitions are quite similar or a bit similar with what you're talking about supply and demand, which is the point where significant buying power or significant selling pressure came into the market. So this is the last candle before a down move, or the last down candle before an up move. That's one way to look at it, in which in this case we had prices chugging along back into this region, and then we had another push upwards. So it's good to identify these zones because they give us a good base to look for entries. But the zones in and out and by themselves are not really significant. You have to sort of combine that with other factors, and you're going to see that shortly. So here we have what you call a balanced and an imbalanced market. Yeah. So let's go back to the concept of buyers and sellers running a market. And I'll just have this here. Yeah. So so we've said when buyers are more than sellers. So if we have buyers being more than sellers, then prices on the chart tend to rally upwards. So in this case, you can see that whenever there's more demand than supply, prices usually just tend to go up. Yeah, and the vice versa is also true. So when there are more sellers than buyers, then in this case, you can see that interests or very few people will be outbidding each other or outdoing each other, thereby leading to a drop of prices. Yeah, so that's basic market dynamics. But then when we have buyers and sellers being equal, that is, if you are in a market where both buyers and sellers are matching orders, then that's called a balanced market. So in this case, we will have very little movement in prices, and that is what we call a balance. Now, balances and imbalances come from this thinking. So in this case, you can still, can I have, let's see. Now, the degrees of strength in the market also really affects how prices move. So if buyers are significantly more than sellers, so if you have a scenario where buyers are significantly more than sellers, then in that case, you have what a very huge, in the market, it's usually very huge up candles or very steep price movements when buyers are significantly more than sellers. So you find in that case, price fails to form pullbacks. It fails to form properly as we trend higher. The same way, if we have significantly more sellers than buyers, what you see on the chart is a very steep drop. Yeah. So you can see steep the price failing to form pullbacks, and we just move steeply lower. Yeah. So remember, you're trying to identify areas in the chart where there was significant buying or selling. So when you're identifying a supply or a demand zone, it has to be followed by an imbalance in the market or a very sharp move of prices that is going to validate that zone that you're looking at. So for example, if I go back to the charts, let's go back to these charts. If I'm looking at a zone, for example, this zone over here, then it has to be, so this is a zone that we can identify. Just a minute. So if you look at a zone like that one, where we've identified the last down candle before that up move, you can see that the characteristic of that, the range of that candle in comparison to this up move. So the range of this up move is, let's mark this out here. Yeah. So this demand zone is significantly, or the range of the demand zone is significantly small as compared to the resulting up move. And that is one important thing you need to look at to validate either demand zones or supply zones. Number one, do we have an area where we had significant buying? And that significant buying being shown by actual huge candles on the chart. Yeah. And huge candles and big candles that are moving without pulling back in the market. So this clearly identifies that this region over here is indeed a demand zone. The other thing is you can have a zone, for example, this one. Let's look at this zone previously here. So let's look at this one. Yeah. So if you have a zone like this and you see that prices have moved away from that zone, number one, there was a wick that came back into the zone. So this isn't significant buying or selling. Why? Because prices didn't dramatically rise away from that zone. So you can say, yes, this looks like a demand zone, but prices weren't aggressively pushed away from that demand zone. So it sort of guides you. And the best way to look at it is your demand zone, the range of your demand zone should be at least a third of the resulting move or of the resulting impulse move. So this is a good example over here, and this is another good example, yeah, in which the push upwards. So I can identify, let's use this. The resulting upwards move is the range of the upwards move is significantly bigger than this consolidation that we had here that led into this. So this is a rally-based rally type of demand zone over here that we're looking at. And this is a drop-based demand zone, drop-based rally demand zone that we're looking at. So again, for the definitions, you can always go to the start of the video. Okay, so that's how you validate your zones on the chart. You need to check how large that zone is in comparison to the resulting move, especially if you're looking at areas to trade within a trend. So let's just go back and see the definition over here of an imbalance. So this is insufficient trading in the market, sometimes called a liquidity void. When there's insufficient trading in the market, the price often comes back to fill out these orders that are left when an institution wants to. So basically, when you have one side of the market being or overpowering the other side of the market, then there is insufficient trading in that buyers take up all the liquidity, all the available selling orders and sort of leave a void. And this usually tends to attract prices, but then it also shows a sign of significant pressure from one party. And that's where the concept of validating your zone comes in. So orders might force price to move away from a given level with strength and magnitude, leaving behind liquidity voids. So these ones are often filled, and then we can use this to assume sell orders that were unavailable at that level or not enough to pair the buying orders. So prices may therefore come back at initial level. So just to let's have a recap of what we did in the last session while we look at this. So we talked about the concept of identifying an uptrend. So I'll mainly use an uptrend for this session. If we have a series of higher highs and higher lows like that, yeah, then points where you have prices pushing out to break previous structure. So points where we have prices being pushed to break previous structure are ideally where you should be spotting these zones, these supply or demand zones. So they can either be at the very best of that impulse move, or they can be somewhere around here. So you can have a rally-based rally type of demand zone, or you can just have a drop-based rally type of demand zone. So these are areas where so let me just do this. So we've had an impulse move, a correction move. So if we have a demand zone coming out at this point where prices later spiked up, so this is where ideally traders will be looking for a pullback or a correction move back into this region, so that now we can get a re-entry to go higher. And at that re-entry, then we'll obviously look at other structures, but this needs to be validated using obviously your knowledge on order blocks and consolidation, and this needs to be an imbalance. So this push higher needs to be an imbalance to clearly validate this being a demand zone. Yeah, so let's just have a look at that on the charts while we are at it. Okay, so I'll just go to the latest. So I'm mainly using GBP USD. Again, for most of these pairs, it's usually good to use pairs that don't have quite a lot of momentum, because for pairs that do have a lot of momentum, in many cases, you don't really see the prices coming back when you're trading. So you really have to be careful with that. Okay, so can I zoom out on this? So here we had a consolidation, so I don't think we have a clear trend to look at. Maybe we can go to a different chart. So remember, all that we've talked about, actually this is a good example, all that we've talked about in the previous session still holds. Let me just get rid of this. Okay, so step one, we need to be trading in the direction of the trend. And if you've not watched the market structure video, the link will be in the description. we basically learned how to identify trends in the market, and this will help us know in which direction we should be trading. So we had a series of highs. So in this case, you can identify this as a high over here, and this as a new high over here. Yeah. So what you're trying to do is whenever price pushes back, so this was the move that caused, this can be a low, but specifically this is the point where we had a consolidation, then a move higher. So this is going to be my supply zone, or sorry, my demand zone. So I'm going to mark this like this over there. Actually, it's a very small region like that. Yeah, so how do I validate this? First off, we've marked the trend. We know that we're in an uptrend, so we're looking for demand zones. Secondly, we identify the specific demand zone that we spot on the market. Third, we validate that demand zone. So validating that demand zone means seeing, for example, number one, did it cause imbalances after it was formed? So in this case, indeed, these two candles were really huge and there was no pullback. So if you see prices moving in one direction and not having any pullbacks, including wicks, then this is clearly an imbalanced market. Yeah, so that was the first step. The second step is this move more than 3 times the size of the range of this pullback? So the range here, this looks like a very small range like that, and you can see that it fits in more than even 3 times the range. So the move is indeed bigger than the range of the zone. So in this case, it validates. So I'll just mark this over here and then mark this over here. So in this case, our demand zone is validated. So all you have to do is wait for prices to retrace back into this zone, and that is where we look on to the next segment, which is waiting for a change of character. So once prices have gotten into your zone, all you need to do is wait for a change of character in the direction of your trend, and you have your trend. So going back to the notes, you can see over here, this. Yeah, so a change of character, as defined again from the previous video, is when we have the market shifting from being an uptrend to a downtrend. So it's basically when you have 2 highs or 2 lows being, or 2 new either swing lows or 2 new swing highs being formed in the opposite direction of the trend. So in this case, for example, if you're making higher highs and higher lows, when you eventually broke and made the first lower low, and then made the second lower low, then we're officially in a downtrend. Yeah, same thing with here. If we broke, if you are making a series of swing highs, or sorry, swing lows and lower lows and lower highs, then eventually we broke and made our first higher high, and then our second higher high. So after we have identified and validated our supply and demand zones, the final thing is to wait for a change of character with or within the direction of the mega trend. So in this case, we're going to define a change of character as having or forming your first 2 lower lows or 2 higher highs. So in this case, if you're swinging higher, if the trend was in an uptrend and we formed our first low and then pulled back and formed our second low, then we are officially in a downtrend. The same thing, if you're in a downtrend and we swinged higher to form our first higher high and then our second higher high, then in this case, we have changed the direction to becoming an uptrend. So you can get aggressive or you can get conservative with where you place your entries. Now, let's look back at our example on the chart. Once you have identified the supply zone, validated it using the imbalances, and you've seen prices being driven back into this zone, you can then switch to a lower time frame, for example, a 15-minute time frame or a 5-minute time frame, and from there try to identify that characteristic. So in this case, what you're waiting for, because this is your significant lower high, and this is your significant lower low, you're waiting for a change of structure. So again, this being your significant lower high is because this is the base where this impulse move broke the previous lower low. So this move over here broke this point, and now this is where you'd be looking to see, a change of character in the market. So once you have prices breaking this area over here, then effectively or technically we are now in an uptrend in line with the 4-hour uptrend, which was this one over here. So remember, we had prices moving up like that. Yeah, so that's one way to look at it. Yeah, let's go to another chart, perhaps Euro USD, and we start with the 4 hours. So first things first, and very important, is you need to identify where the zone is. You need to identify the trend, number one, before identifying the zone. So in this case, you can sort of mark our levels. So you can see I've already been marking these levels on the chart. Okay, so we had this break over here. So this move resulted into, number one, an imbalance, and then we moved way low like that. And then from this point, the next move that resulted into a break of a structure, I think in this case, it's this move over here. So it's a very tricky one. But this move resulted into a break of structure like that. Yeah, so now we can only see it again. To talk about why we have pointed out this point and not this point, the previous video will explain it very well. That is, this is the base of this down move that broke this low. So this is where this move started. So this is your validated significant low. Yeah. So now getting onto a different time frame, you'd be looking for the base of this. Now this is where the definition between order blocks and supply and demand zones kind of vary, because now an order block will be the last bullish candle before a down move, but in this case the initial point where sellers started selling was here and not here. So it's going to be you zooming into the charts, into lower time frames, until you find that specific point. So you can see we are now identifying more candles as we go higher until you find that exact point when the selling pressure began. So in this case, I'll just continue to move lower and lower. So you can identify this region over here as it being the starting point for selling pressure. So the base of the origin of that move. You can put that all the way till there. So just a minute. Yeah, so the base of that move over there is where our sellers came into the market, and this is where I'll be waiting for a change of character. So how exactly did I get into this? Again, sometimes the definition of an order block might not necessarily fit into the definition of a supply zone or a demand zone. So it's best to understand what a demand zone or a supply zone is, and that is the point when significant selling came into play. Yeah, and that resulted into an imbalance candle. So a very huge candle with no pullbacks. And in this case, we have zoomed into the time frames to find the exact point where sellers started selling, and this is where we'll be looking for prices to come in. So you'll be wanting to see prices coming into this zone, and then you wait for a change of character. That is, in this case, 2 consecutive lows. So if prices come to this point and form the first low like that, and another low. So you can either be aggressive at this point and enter on the pullback, or wait until it's a confirmed downtrend. Now that depends on how the momentum of the market is at this point. But then again, we are trading in line of the bigger downtrend. Yeah. Okay. I believe that's it for this session. It was a very short session because most of it we've already covered in the market structure session. So just to recap what we've said, The first thing as a trader is to identify the trend in the market. So the first thing as a trader is to identify it. Before you start considering supply or demand zones, you need to know the bias or the direction you'll be looking to trade. Will you be trading into demand zones if you're in an uptrend, or supply zones if you're in a downtrend? Once that is identified using market structure, link is in the video, then the next thing will be now to find those zones on the chart. And that's where the process comes in. Finding either an area of consolidation where there was a spike in prices or a drop in prices, of which it needs to be validated by either imbalances or just huge spikes with no pullback, or a movement with no pullback on the charts. Once that is validated, you wait for prices to get back into those zones, and that's where you wait for a change of character before taking a trade. So that's basically what we've covered in this supply and demand video. You can see it's really a complementary strategy to market structure, and in and by itself might not be very much of use unless you know you're integrating it onto a different strategy. So having said that, thank you for attending this particular session for supply and demand zones. This is a primer, or it's an add-on to what we've just done with market structure, and I hope it's going to be of use. In the next videos, we are going to drift away from technical analysis and venture into fundamental analysis. We will introduce how to trade news, and specifically CPI and NFP news. So thank you, and see you all in the next video.